So yesterday, a woman called our office. She was interested in a whole life insurance policy, and she was mainly interested in using it for real estate. She said, I want to get a whole life insurance policy. I've been doing research for a long time. I get how the cash value works, where once I put money into it, it's always at work for me, and then I can use it for real estate. That's what I want to do. But here's where I'm stuck. I've looked at whole life insurance policies. My husband and I have spoken with a number of agents, and we just can't get the right policy. It doesn't look right. For example, what she wanted to do was have a policy where she paid $100 per month, but could start the policy off with $10,000 or even $20,000. She said, can I pay just $100 per month, but then still pay up to $10,000 in the first year and every year after that? And really what I'm interested in, Steve, is really maximizing that cash value. This way, I've got a lot of cash value or equity in this whole life insurance policy that I can then use for real estate. And this is always the problem that comes up with whole life insurance. I'm trying to get everything right with the actual policy, because if I get it right, then it's easy to use. But where people have buyer's remorse with whole life insurance is when they find out after they started a policy that it wasn't set up for high cash value. So today I'm going to go through exactly how you can set it up, and we'll go through a pretty cool exercise with one life insurance product with the same company, but we'll go through some different versions of how we can set it up. So what we'll hit on is this. We're going to follow a storyline similar to what that individual I spoke with yesterday had expressed. She's setting up a policy for real estate. She wants a policy that first maximizes the cash value, but second, she also wanted payment flexibility. Do you remember how much she wanted to commit to? $100 per month. How much did she want to be able to pay into the policy? $10,000 per year. So here's the question I would ask if I'm you. Can I have a policy where I'm just billed for $100 per month, and then at my discretion, I can add more money up to a total of 10, and whether I hit it or not, that's up to me. But if I get more in, it all shows up in cash value in that paid up additions rider? The answer is yes. And the last bullet point you see here, this is the most important thing. We always want to get the cash value right first and then look at loans. Because getting the cash value right, that's where people have buyer's remorse. When whole life insurance is debated or told that it's a horrible place to put money, it's always about the cash value. So let's look at a simple example. We're going to look at a 40-year-old individual paying $10,000 per year. We're going to look at one guardian policy. You've got options A, B, and C. And what do you notice about those? They're all the same. $10,000 per year for 10 years. They'll all be the same company, all the same product. They'll just be set up differently. Let's begin with option A. So here's the illustration for option A. $10,000 per year is being paid for 10 years. So that column net premium, we see $10,000 per year for 10 years. After the 10th year, how much is paid? $0 out of pocket. Now the column to the far right, second to last, is your money column, your net cash value. What's your cash value look like in the first year? Not that good, does it? You paid in 10 grand, you've got $300 to show for it. Now, what I want to highlight here is if we go back to this column right here, this box right here, what do you notice? Annual premium, $10,000. Keep that in mind right there. Annual premium, $10,000. Okay, let's look at option B. So, option B, annual premium, $5,000. You're paying $10K per year though. Here's the other $5,000 going toward what is called a paid up additions rider or a PUA rider. So your net out of pocket is exactly the same as option A, $10,000 per year. Look at your cash value in the first year. Is it $330? No, it's just over $5,000. This is the same product with the same insurance company. Ready for option C? Here we go. So option C, we've got this one in green. Annual premium. What do you notice here? It's less than $1,000. Your paid up additions rider. What do you notice here? Just over $9,000. Out of pocket, $10K per year. Look at your cash value, over $8,700. These were all the same policy. If you were to compare them side by side, which policy got your money back faster? Option C. You can see by year 4, your cash value is equal to your total payments. Total payments by year 4, $40,000. Total cash value is what? $40,000. Look at year 4 with option B, $35,000 in cash value. What about option A, $28,000 in cash value? What was the difference? That premium figure and then the PUA figure. So which option gave you more money in the short term? Well, if we look at the first year, that screams at us. Easily option C. How about year 10? After we've paid the same amount of money into the policy, and again, this is the same product with the same crediting rate and everything. Well, by year 10, the answer is still option C. We've got $118,000, almost $119,000 with option C. And if you look at B, you're at $107,000, just about $108,000, and option A, you're at just about $93,000. So significantly more in option C. What about after we stop funding? How about by year 20? Who's the winner? Option C. You're at $191,000, whereas the other two, we've got B at about $177,000 and A at about $155,000. So you've got more money from year 1 through year 20 with option C. And again, same product with the same company, same out of pocket to you. The only difference is how we set that policy up. What about by year 30? Option C, clearly more. You're over $311,000, where the other two are still under $300,000. So option C has the most money from start to finish. Why? Because again, it's the same insurance company, same whole life insurance product. You pay $10,000 per year. Like, what's the difference? Remember that box in red that we started with in option A that was $10,000? It said annual premium. That was what we call your base premium. And then the column the box we had in blue, that paid up additions rider, that's our PUA rider. How we set the policy up is the most important thing to do in order to maximize cash value. Here's a simple way to explain it. Base premium dollars first get you life insurance and then eventually build cash value. Whereas PUA dollars, people put money here because first it builds their cash value and it also gets them life insurance. Now, usually when you pump money into PUAs, you'll see anywhere from 2 to 3 times your PUA payment purchased an additional whole life death benefit. So it will grow the long-term death benefit of your policy as well. With that said, most people we talk to say, I don't really care about the death benefit right now. How do I maximize the cash value? The answer is we want to get as much money as we possibly can into that PUA rider. Make sense? All right. Let's look at the 3 options again. We'll recap here. So we've got option A. How much went to base premium? $10,000. How much went toward your PUA rider? $0. As a result, the cash value is not attractive. It takes 12 years just to get your money back. What about option B? Well, we split it down the middle. $5,000 toward the premium, $5,000 toward the PUA. What do you notice about the cash value? It takes about 8 years to get your money back. Option C, well, there's your clear winner. Base premiums at $1,000. It was actually less than that. It was $910, but we just rounded off in this example. And it takes 4 years to get your money back. So a question we get here a lot. You may be thinking the same thing. Why would I do anything other than option C? Here's the 2 reasons why. This is what I've seen the most. 1 is lack of awareness. I'm only presented option A or option B or something similar to one of those. And then 2 has to do with the agent commission, what I would be paid in a case like this. So here's what I would be paid with options A, B, and C, and this is exactly what our compensation rates are with this insurance company. So we've got the first year commission, as those typically are the heaviest with whole life insurance products, and then we've got the 10-year total, which includes the renewal commissions too. And typically you'll see this. The more cash value a policyholder has up front, the less the commission is that's paid to the agent. That's usually how it works. Think of it if you're the insurance company. Your money can go toward one of two areas, toward the policyholder or toward the agent commission. Of course, the insurance company makes a lot of money too. They know what they're doing. But when you look at how commissions work, the higher the premium is, which does not show up in cash value, the lower the cash value is, and the higher the agent commission is. More premium equals more commission. So what we always do when the goal is to maximize the cash value is we'll aim to minimize the base premium and maximize the PUA rider. And this is also what corporations do when we'll set a policy up for a corporation or a small business that is taking policies out on their executives, and the cash value is an asset on the balance sheet. We will minimize the expenses as much as we possibly can. So when it comes to minimizing the base premium, what you will see is that a lot of the top insurance companies will allow us to set that base premium as low as 10% of whatever our maximum is. Sometimes that can be confusing. What do you think I mean when I say our base premium can be as low as 10% of our maximum? Well, a question I like to ask a lot is, how much would you like the ability to pay into your policy on any given year? If you go back to the woman who was interested in this policy for real estate, what was she interested in paying into the policy? $10,000 per year, but she wanted a minimum of what? $100 per month. It's $1,200 a year. If we compare it to option C, it's like the $1,000 per year minimum. So here's how it would work. If you said, the most I want to pay is $10,000 per year, what we would do is see how low we can go with the base premium, in this case $1,000. That would be your minimum commitment, and then you can add PUAs up to a total of $9,000 per year. If you said, I want a bigger policy than that, the most I want to pay is $100,000 per year, then we would do the same thing with a zero. The base premium would then be $10,000, and we can add PUAs up to an additional $90,000 per year at our leisure. Now, when I say at our leisure, the insurance company and their flexibility rules around the paid up additions rider is very important. We've got other videos and such you can check out that provide a full overview on that. But my point is, if cash value is very important, what we are going to do is minimize the premium as much as we possibly can, maximize the PUA rider, and that also makes it very flexible. This way, I don't feel like I'm on the hook to pay this big premium, because remember, she did mention that flexibility was really, really important to her. She didn't want to be on the hook for $10K per year, just that $100 per month. So going back to option C here, if this is your policy, what's your minimum? There you go. The base premium of $1,000. So I do hope that this video was helpful. Please let us know your thoughts and if you have any questions. And again, as always, I hope this helps. Thanks so much.